Thank you very much, Sean. Thank you very much, everyone. Happy Saturday. Welcome for another session of RM Smart Investing Weekly Market Analysis. I hope you have your notebooks because I think this is going to be a fun-filled session after the week that we had. It was pretty volatile week for a few reasons, which we will discuss. But it was not for the faint of heart. It was with a very volatile every single day. So we will review that. We will. I do have about, I think, 8 or 9 lessons of the week, and I hope they're helpful with more of your knowledge as well as the tradings, and giving you a little extra edge. That's what we try to do at times like this. I think it's beneficial. I just had a few also trade of the week, so hopefully it will be a productive an hour and 20 minutes. As always, we will start with economy. We really want to go in depth and review the markets because, again, I think last week was a very good week for understanding the markets. Things have been some kind of a cruise control, easy going for the last year and a half in some ways. And the weeks like last week kind of gives us a dosage of the reality. So as I mentioned, we will have some good lessons of the week and the trades of the week. So let's start with economy. And the reason it is, obviously, last week we had number one, we had the job numbers. We had the Treasury Secretary Janet Yellen. We had the Fed Chair Powell. We had also this Omicron coming previous Thursdays. So Thursday evening, Friday, we had the reaction. So we'll dive into that. So the first thing is, as you can see, again, with the job market itself, the jobless claims have been, just improving. So people are going on the unemployment, getting reduced and reduced. The staffing is actually way ahead of what it was in 2019. And the retail sales are up there. And this was as of November 27. So basically, we've had that improvement. Of course, when we think about Friday, the Black Friday, most of the things is about this, the variant, the virus. But it was, and then Monday, we had the Cyber Monday. So the retailers are doing well. Despite all the supply chain problems in that sense, people are out there and they have the money, seems like. The box office, I won't put too much. Again, I think the behavior has changed. So although there's some good movies are coming out. And then the commercial flights, that's one thing, I look at month over month, it was tiny bit, it's just pretty flat, week over week, was again flat, but we are still below that. And I think this variant is not obviously helping the situation, with the Germany tightening, and as I mentioned, with the UK, and I think with the US, I'm kind of watching what's going to happen, talking about even US citizens going to have more, that's a talk right now. I don't think that's become the law yet, that they have to have the 1-day pre-COVID test. It used to be 72 hours. And then also they have to have a COVID test upon arrival. That's what the UK has been doing. So those are the concerns. So the Omicron is part of our equation right now. So for a while, we had the reduction. The summer we had, if you recall, we had the increase and then it went down. And now I just start to share, this is as of December 2nd, places they had a case of Omicron. And then we want to look at what is happening, the 7-day moving average, as far as the new positives. So you can see, as of September, we were going down, and now we should watch this. And basically the vaccination. The other thing was last week, which was, again, it was a pretty busy week with, again, with all the speeches and all the hearings. And basically, it was the unemployment number. We talked about that. Just be careful. In some ways, it looked like non-event, but it was, affecting the markets. I think the markets, they had concerns about the debt ceiling on December 3rd because the can had been kicked down the road to December 3rd. So that was, again, kicked more down the road. So, but for now, it seems like it's okay. Uh, One thing, and then the US, obviously, there was the numbers came at 210,000, way below what the expectations were, at 553,000. Although the private sector had a big chunk, it was the government sector which had the reduction. One word of caution: it seems like after the, around the COVID, uh, the Department of Labor statistics, and these numbers come from, they have really changed their formulas. So a lot of times when we compare to 2 or 3 years ago, it is not exactly what it was before. So there is always some adjustment. So we shall see. And I think the seasonality plays a role. So although this number in the surface, it was not very good, but I think next month things will be completely different. The other thing we have to recall, obviously, the bad numbers come out kind of on the normal times, that the markets will react well. Maybe the Fed will not taper. Maybe there's a little more hope for the not having, let's say, two increasing rates. And But as you know, Friday was very volatile till the last minute, actually. So the average hourly that I pay attention was expected 0.4, and it was actually the earnings were 0.3. One thing, obviously, there was cheering. We are back to pre-pandemics in a sense. Is that the lowest we've had is like the unemployment rate went to the 4.2%. Although it seems like the participation rate has gone better, it was up. But this participation rate, there was an interesting study done last week that it showed that about 5.7 million, either they've had COVID, or they're taking care of someone with COVID, or they've just decided to leave their business and start something on their own. So that's also, you have to take into consideration with the participation. I'm going to deviate from that, and I want to show you what Canada did. Canada was expecting 36.5 thousand employment. And again, it's a small population, and they just blew it, 153,000 as far as a new employment, and unemployment rate dropped from 6.6 to 6. The thing was, with these numbers, you would expect the Canadian dollar to rally, but there was nothing. It fizzled, and most likely it has become, Canadian dollar is a commodity or crude oil kind of a currency. So we've had, obviously a big correction in the crude oil prices, which we'll discuss a little later, and that affected the Canadian dollar. Otherwise, they had this was a very impressive number. I just thought to share this chart with our unemployment rate going back actually to 2013, where we have been. This is what we expected, and the blue is what actually had happened. So you can see the expectation where we were and where we are now at 4.2%. So just a food for thought. For this week, really the big event will be on Friday, next Friday at 5:30 a.m. And that's the CPI number and the core CPI, just the expectations, what happens month over month. And obviously everybody's watching this because there's that concern about the inflation. Okay. One of the things that actually happened last week, if you recall in the testimony, Fed chairman finally came out and said he doesn't think this really, they're taking the concept of the inflation being transitory. He's thinking it's more serious that it might not be, and Janet Yellen also emphasized that. So they're taking that very much into consideration. All right, let's talk about the markets. Let's start with the sentiment. Last week, we talked about the AAII, American Association of Individual Investors. We explained what stands for, what we have to look at. As I mentioned, it's more productive on the downside or on the bearish side or over negative side, negative sentiment, than more on the positive. So now this is the highest we've been in over a year. It's still not on the one standard deviation, but getting close to that. So bear that in mind on a short term. So we are at 42.4. So there is anxiety out there. But the problem is, as I mentioned, you can see, how the numbers are all over. I mean, what has changed in the last 3 weeks? You can see there's been a big drop and big increase. Is, again, we go back at recency bias. So people react to just the latest news and events. The same thing with the CNN fear and greed, which in our lesson of the week, I will go over the components of this as well. Now, this is one of the lowest we've been. We are at the 20. So from the sentiment point of view, you can see we are getting close to the extremes, or actually at the extremes. So that's from the sentiment point of view. Let's see how the markets, what markets are telling us. Oh, by the way, let's also, let's look at the euphoria. We still, the Citigroup still, they are on a very positive as far as their expectation of the markets. So this is the week we had. Now, if you went to trading every day, you would think we should have been down like 8% or 9%. It looked very painful. I don't know if you were involved. I hope some of you took a break, just enjoyed yourself rather than playing the markets. Or if you did, it had to be very cautious. As I mentioned, it could have been very profitable, but also being so volatile, the stop losses, if you were day trading, were hit quite frequently. So this is what we had last week. We had the Dow Jones, that was of all the indexes, it was down, it was the lowest, was 0.91. And the only positive one, which is the risk off, was the money going to the utilities. As we will look at, see that the bond market was pretty stable. So that's where the money went. But other than that, everything was negative. So the small caps being the biggest really proponent of the downsides. And then, the S&P was down 1.22, NASDAQ was down 2.62. So the advanced decline, last week we were 27 to 8, this week we were 24 to 10. So this, the soldiers were marching downwards as well. So basically, as far as the dollar was pretty stable. So which is very interesting, why the dollar, with the what's going on, they have stayed strong. We will look at the charts. So, if there's a fear of inflation, if there is, as far as the rates going down, but the dollar has been the strongest because of the fact that really there's no other closure. I mean, if there's the concerns with the Fed, with the inflation, the rates could go up in the future. So the dollar is really a discounting factor, and it is where the money is. So as far as the security, so the dollar is holding tight. We will look at the charts. The bonds, like they stayed strong, although it looks like flat. But we will look at the charts. The crude oil, after the OPEC meeting, now we've had these few countries in the United States, including the United States. We had the strategic reserves have been used, which is really, they are basically for really critical times in the time of crisis, and they're not that much, right? But it was open, so it helped. And then OPEC, they had finished their meeting on Thursday, so the question mark is they're going to keep everything level with the supply. So the market actually went down a little bit more. The fear of this Micron really not helping the facts. So the demand is down. But if you look at the chart, see how far lower we can go. As I mentioned, for the OPEC 70-75, that's the area they'd like to have. $60 could be the ultimate floor. But when you look at like from Goldman Sachs to Bank of America, you look at Morgan Stanley, they've come out for the next year, for 2022, they believe that crude oil will go to the 100. Their reasoning is, again, the political things in the United States, not the shale companies are not being productive. Again, with the political side of things, and we're not having the obviously the Canadian transit as far as the oil goes, that had shut down. And they believe that there's a problem with OPEC supply side of production. They're aging technology, so they don't believe the supply could be up there. And the belief is this the variant of Omicron, if that's a transitory and it's going to fizzle out, more people are going to get vaccinated, so the demand will come back. So that's the thought. So just a food for thought. That's what they're thinking. We'll see over 100. But in the short term, I think we shall see what happens with the charts. I will explain where we stand. Now, the inflation number was a little lower, obviously, because of the oil and the gold. Now, this looks like flat, but again, that was a pretty volatile week for all of these assets. So we will watch that in the charts. I want to include this. I mean, again, it felt like the bottom has fallen off, but in reality, we hit the all-time high in Dow Jones on November 8th. And as of now, we are about 5% down. So about 10% will be correction. 20% will be going to the bear market. So we've had a 5, and from the low from January 29, we are up actually 15%. Now, when we talk about S&P, we are at 3.5% down, really, from the high that we had hit at 4704. And the NASDAQ, we are down 6%. We hit again November 19th at 16,057. And oil, well, we hit 84.65 end of October, and that's a pretty big correction. So we have to watch this. Before I look at the charts, let's again see how we can analyze this market. What has been happening? Again, one day up, one day down. One of the things you have to be careful with what has happened with S&P, the days that we were down, the days we're up. I don't know if I had mentioned it. You can see the financials really had gone down. It was the NASDAQ and the big caps, the mega caps have been holding up the NASDAQ. So if the financials go down because of the downward pressure on the interest rates, the bonds are going up, money is going there. So the financials were on a downtrend. It was the NASDAQ and the big caps are holding S&P. Now, if we lose that support from these mega caps, then watch out, because those are the two biggest components of the S&P. And that's what I want to share this for the week. You can see that basically Apple was up. Google, which has been up 65% or so, was pretty flat. And Microsoft was down, Tesla was down, Amazon down, but it was not a huge drop in them. Once there is the volatility here, once the volatility increases in the movement of these stocks and then the profit taking happens, that's when we have to be concerned. So right now they're holding the glue. We want to watch the NASDAQ. We want to see if the NASDAQ accelerates as far as it going down, it is going to take I believe S&P with it. So that's why I want to share this with you. So you want to watch these mega caps and see where they stand. So now Tesla, for instance, that when I looked at like Tuesday, I mean, on Friday, if you go back, look at the sizzle index, look at the options on Tesla, the first time in a while, I mean, there was more put buying than call buying. And what happens now, we could have the gamma squeeze to the negative side. So what's going to happen, a lot of, again, uh, institutions, fund managers, if there's a gamma squeeze the other way, they have to, when the losing on the delta positive, they have to get the delta negative, which that means shorting the, let's say, S&P futures. So let's watch that closely. Let's watch these. Now, something like, NVIDIA is becoming a player. Still has been unbelievable, but it's becoming a prominent player, part of the NASDAQ and S&P 100. So with that in mind, let's dive in this some extra charts that I want to share. This is one of them that I watch. Now, this one is I look at it, it's part of it, don't share it all the time because the other moving averages are very similar, but this is one of them. I look at the 8, 21, and 34. There are Fibonacci numbers. These are the exponential numbers. And basically what I like to see is when we have the uptrend, for instance, the shortest term is the 8 exponential moving average. So I want to make sure the prices are above our short-term moving average. So that tells us the strength, the momentum, and that means that the trend is up. So as long as 8 is above the 21 and 21 is over 34 and 34 is over 50, then we are in uptrend. And when they converge and they open up, usually this is a strong indication that we are going to continue with our trend. And you can see even there's less opening, that's more strength. Then when we go so far away from the moving averages, that's when we will have some type of a retracement or pullback. And you can see this would have been a very nice trade. We stayed here and then we flattened. And now what is happening with this is 8 is going under the 21 and crossing the 34. And looks like now 21 is trying to cross. So that doesn't bode well, at least in a short run, to the market. So we want to watch that. It has happened before. We tried to retrace it, came back. So once we get this convergence, then if we break above, so these are the lessons that you want to, again, go back in the history and take advantage of it to see, if you want confirmation, if you want to go long, if you're going to have Santa Claus rally this year, which actually started, it did it in November, beginning of November, and then looks like, there's exogenous events are taking care of that. So basically that would be a good way of confirmation. Now, our regular charts that we've been looking at, if you recall, the day before Labor Day, we had the all-time high on the S&P futures, and we looked at the retracement. We hit the lows in October, beginning of October, September, and then we had the extensions, and we've been talking about this 161.8, how many times we tried to break it, and finally we could not break. And this is representation of the last 6 sessions. When you have big bars like this, these are a market which is lost. And what I mean by lost is there's no direction. There is no really indication which way it's going to go. There's a little bit of panic. Obviously, I think last Friday was also a part of profit taking, an excuse. And guess what happened at profit taking? Right at 161.8. And what did we do? We broke below the 8 and the 21 for 20. And we went on Monday, we had a rebound, which I'll discuss it, why we had it. But where did we go? We went to that 8-day exponential moving average. What happened on Wednesday? We broke down. We got rejected at 138.2 and even 127.2. So we went down, closed right on the 50-day moving average. The same thing on Wednesday. We go all the way up to 138.2, trying to break above the 8 and 21. And what happens? We close below the 50-day moving average, as well as our initial move that we talked about, the high of the September, or the all-time high, which we started September. You can see now this zone. So we don't want to really work on absolute numbers. We want to work on zones. So for me, for instance, 4,500 area, which is 4,500 to 45, like say 35. That's the zone that I want to watch. If it break below that 4,500, then we could go to our ambush zone. We can go down to 40, as far as like 4,300, 60, 350. So you see the battle here. The last, really, when we look at the last 4 days, we had this battle going on. And right now, what happened on Friday? We closed right where we were on the high of September. So that's why charting is really good, because visually it gives you some type of at least sanity to see where things could head, where the support will be. Now, one of the things is asked is, oh, the volume is high. So we see that a lot of distributions. Now, the problem with this is when you have volume like this, when they're high, but they're not capitulation, that when we have like a really huge volume spike, that means now that's aha moment, looks like the sellers are done, but we don't see that. So what happens if you get like 3.6 million, I would say, in the S&P futures, that's something, a sign of like, okay, this could be a reversal. When you have high volume, but the continuous volume, that's like a drip drip. So just be careful. So for next week, we want to watch the zone, see if we're going to hold it. Now, we were going to go further. Let's, again, we've talked about all the asset classes are very much related to each other. So let's look at from the Bollinger point of view with S&P cash. Let's see what happened on Thursday. Thursday, we hit that 100-day moving average and we bounced back. The question is, if you recall, that's one of the main reasons I like to always consider the 2-bar confirmation. Once we broke below that 18-day moving average and we could not go back, right there, that was telling you, the next support will be either the Bollinger, which were outside. We were 1, 2, 3 days outside the Bollinger Band. The next support will be that 100-day moving average, and we hit that. The other thing was we had been overbought, the momentum went down. So now we are oversold and actually getting embedded. So we want to watch that. Now, if the market, let's say Monday, comes back out and the momentum changes and we have a bounce, then if the momentum, we want to go up, I've drawn my 50% in my stochastics. Once we pass the 50, then we are in, momentum is back. So we want to see what happens to that oversold. Obviously, we talked about MACD, there was damage done. So the trend was down, and we found out last week that, that was a confirmation. When we look at the weekly, on the other hand, this is important because on a weekly basis, that means we are sitting right on that 18 weeks, but we've had 2 red candles in a row, and we've had very few red candles in a row sitting on that 18 weeks. So we bounced back whenever it happened. The question is this: the stochastics on a weekly basis, we went to overbought from embedded, and what has happened this week becomes crucial, because if the momentum continues going down, then it will continue going to the 50, and we shall see what happens. The only savior will be that we turn around and start a new embeddedness. So what we've talked about is, now embeddedness is 3 weeks or 3 days in a row being above 80. Now, we have times that you can have like one day go below the 80. And if you reverse back, it's almost like the continuation. But if it goes to the second bar and we keep going down, that means the momentum has changed. And usually that means we will go to the next line of support, which in this case on a weekly will be the Bollinger Band. So let's watch that. The MACD is kind of flat as there's a challenge here, and we can see it's turning down. So that's as far as the weekly. So the weekly is not trying to hold itself. So next week, we want to see that the momentum change on the stochastics. Now, NASDAQ has been, again, the key holder. So there wasn't as much damage, but it's becoming not damaged because what we did, we broke under the 18-day moving average. We are now oversold. The MACD is, which took the downturn last week. We have continued with that. And now the next support is that 100-day moving average. On a weekly basis, you can see very similar. It's a little stronger than S&P. We just went overbought, and that's what we like to see next week if we see if this is going to turn around. The MACD is also holding itself. So there's a lot of questions right now with the trend. So this is more of a neutral area. So and we were outside the Bollinger Band. We came back inside. So we want to watch the NASDAQ as well. As far as the Russell and YM, or the Dow Jones, they had already given us the message that there was a big, nice breakout, and then that fizzled. We went inside the channel where we were. Now, the question is, we've had, again, the breakdown out of the 100-day moving average. We are getting very close. This has been my support line for last, I think, 8, 9 months, 10 months at least. And every time it has hit it, I've had a trade on this area. So we are very close to that support zone. The question is, you can see these are big bars. So, and we are embedded. In the past, what it was, we all got very short, we didn't get embedded. We were oversold every time that we hit that support zone here. We hit it here, we hit it here. We've been embedded for a while. So this looks like a little different. So let's see if we can hold. Otherwise, if we break this support zone, it will be difficult. Now, one of the things is, you can see we were outside the Bollinger Band 1, 2, 3, 4. And as you know, usually you cannot stay outside the 5th bar, and we came inside. Now, whether this bar is going to start a new one or we're going to have a rebound, we are still having a challenge at that 100-day. The Dow Jones is kind of similar. It's a little better than Russell. Again, you see 1, 2, 3, 4. The 5th bar we came inside, but we are below that 100. But we do have some support around here. We just became oversold. So let's see if we will continue. And that's the time when we are oversold, coming out of embedded. That's, you want to cover your shorts, but that doesn't mean it's a new buying signal yet. We just want to get more confirmation with the momentum. This is the big one. So we've been talking about VIX. One of the reasons I include VIX is because it does give you some heads up as far as how the market will behave. And we will talk in our trade of the week, something we had discussed in the past. You can see what happened last week. We said, it's like been really challenging, that embeddedness. Now, one of the things we mentioned, this is the Friday's bar, which hit that resistance. We had seen it, twice here. We've had it in October. The biggest one, obviously, the biggest move was in March of last year, 2020. So every time we've gone outside the Bollinger Band, the next session we've come inside the Bollinger Band. You can see every time we've done it, that has given us a buying signal. Now, the question I mentioned to you, like Mondays are not my favorite days. So just be careful what happens. So what happened, as you can see, the VIX did come down and the markets did go up on Monday. And of course, the news of Chairman, we've got the Chairman Powell news and all that, that he's going to be testifying. And basically, that was a positive news as far as with the Congress and what he has to say, in a sense. But what happened was we had the next support zone here, and we bounced right off back. And this looks like the action that we had when the pandemic started. So the markets are pretty jittery. So you can see this VIX has been, this has been I think we've been up here like maybe 3 or 4 times in the past. So in the past 2 years or so. So this is pretty indicative. We came back inside the Bollinger Band. So right now we've had this reversal. So again, Monday is crucial to see if we go back down, go back to our support, will this fizzle? Now, one of the ways we will see it, this is on a weekly basis. You can see we are outside the Bollinger Band on a weekly basis. That's 2 bars. And let's go back. You can see we hit that high beginning of year in January and February. We hit it again in October, if you recall, before the election. And we've hit, obviously, this was the big one. And then we had it again in July. So these are handful times we've been there. But every time after that, on a weekly basis, we have come down, except this pandemic. So that's why we want to watch this, that when we go that high. Now, we see this is one of the very rare occasions we've had 2 green bars on a weekly basis. And that's why I said it kind of reminds me of the pandemics that we had. We went outside the Bollinger Band, 2 bars. Every other time we've had a reversal. So just again, be watchful of your holdings. So we'll see if we get the confirmation next week. The same thing, I talk about the volatility of VIX. That was the heads up we were talking about. I think it was here. I said every time we're at 110, that means something is brewing, and they were not letting up. The markets were hitting all-time high, but the VVIX was still at 110. And this is one of the biggest moves we've had. And you go back and, we can see in May, we were up here. Again, 1 candle here. We've had 3 candles, almost 4 in the sense that has been, going up. So it's not, I think we hit 200 in March of last year. So that tells us markets are still jittery for at least for next 30 or 40 days. The transportation was another victim in a sense. They lost, but now we're getting to the oversold. We had a nice bounce because we were so outside the Bollinger Band. That 100-day would be our support. And then we look at the 10-year note. It's amazing how we went from one end to another end in a very short few days, and now we are all the way back. We broke under the 100-day. This is 1 bar, and we are outside the Bollinger Band. So we want to watch this as far as the rates go on the 10-year note. So we are oversold. So we'll see if we will have a bounce. If we stay under the 100-day, then that's tells us, we could go even lower rate. And the opposite is on the 10-year note. We are hitting a very crucial point, the resistance, and also the 100-day moving average. So let's watch that. We are overbought. So let's see if we will have rejection on the 10-year. And then the 30-year bonds have been stronger. And again, we are outside the Bollinger Band, but we are above the 18 and 100. And guess what's happening? We are actually, the 18 days is trying to cross the 100-day. And that tells us the strength is coming. We are trying to embed. So let's watch Monday as far as what happens with the 30-year bonds. On a weekly basis, we are actually on a 100-week resistance. So that's the food for thought. You recall a few couple of months ago, we were like a magnet. We tried and finally gave up. So let's see, this has been going on since almost March. So since March, we've been under the 100-day moving average. The trend is up, but we still haven't been able to break through that on a weekly basis. And this is what has happened to the financials. So as the rates have come down, this is what has happened to financials. And this 100-day moving average, again, is becoming a big magnet. We have to get some closure. Now the 18-day is moving down. We are getting embedded. Right now we are oversold, so we'll see what happens. So we want to watch that. And if we have strength in this, obviously it will help the S&P. The dollar, we've had, again, with the test money and everything, we are still strong. And the reason is still above the 18-day moving average. The momentum had turned down once we had gone outside the Bollinger Band, but we are above the 50. So let's see what happens. The trend has changed, but this is a good support zone. So let's see if we can hold it. And if we do, then that will bode well for this, but not so much for, let's say, euro. And this is on a weekly basis. So that's what I'm watching. We are embedded, but we have two dojis on a weekly basis. We did go outside Bollinger and came inside. It's still above my big support zone. So let's see what happens with that. The MACD on a weekly, the trend is up. So we want to watch that. So the daily, the weekly, in the long term, you see where we were and where we have come. So let's talk about gold. We will talk about the gold trade as well. But the gold, once it hit, and we shall see, we had this big challenge here. The GLD was, I think it was like 174.50, 174.20, something like that, close to 175. There was a big battle, and then we just could not hold. And we've had a big drop. The gold, the dollar hasn't helped much either. Interesting part is with the fear of inflation, you would think the money will go, and apparently it hasn't. It's gone more towards the dollar. So it's interesting that we have broken down. Now, seasonality, we might have a little down, but then once I have a couple of places that obviously this is my major. I usually am a buyer when we hit the 1682. Let's see if the market, which is embedded, can take a breather and go up, which I will review with our trade of the week. We can talk about it. But you can see we hit our support zone at 1789, and we kind of holding it. So, but there's a lot of resistance coming up. So in order to go to oversold, momentum changing, and to go up, we need a big push to break through that 100-day moving average. Silver, it's interesting. We came and hit my support zone, and we bounced back. So silver actually relative to gold, believe it or not, in the short term has been stronger. But in the long term, you like to have gold be stronger in the relative performance to pull the silver with it. So when silver is leading gold, that doesn't bode well for gold. So let's watch that. But this is an interesting area to watch for the support. As far as the copper, it's kind of breaking down again because of the variant, this Delta, or with Omicron. So that doesn't bode well when the 18 is crossing 100. So let's watch this weakness here to see if it's going to continue. And because we are oversold, the momentum is going down. And the Bitcoin, what happened with Bitcoin? I mean, people who bought up here, you could see we had a divergence. We talked about it. The MACD was going down. We were outside the Bollinger Band. We could not hold this. It was resistance, became support. We broke below the 18-day. Right now, we are at that 100-day moving average and bouncing up Bollinger Band. So this, let's see if this will hold, which has held in the past since August, you can see, and the trend is still as far as the moving average, this is up, but the MACD is on the sell signal, and we are oversold. So, but this is a big support zone. And it was interesting with inflation, money, they would think that money will go to Bitcoin, but not such a luck. So it could go to gold. And I'm looking at it from on a weekly basis. Again, the MACD it's a crossing here. So let's see if this crosses, then and we break below that 18 weeks, then the next uh, next target could be the Bollinger Band, which could create, looks like, whether it's going to be a head and shoulder or not, we shall see. So right around here, the neckline, and whether we will have the right shoulder building. So let's watch for that. And we talked about the crude oil, the breakdown, of course, last week, as you know, what happened with Omicron. And here we are. We are embedded, getting oversold. We did go outside the Bollinger Band. You can see we came inside. So there is a good support here, but we are broken down below 100. So we really need to reach and cross this, because 18-day moving average is going down. So this, we will watch this bar. Let's see if we can hold this as a support and have a reversal. And then energy actually is a little stronger energy stocks than crude oil. So you might get some bargains from the energy stocks, so some candidates. All right, let's talk about expected move. What a week it was. We talked about it last week, and I said that I have not seen this wide of expected move, which was about 154, 155, in a long, long time. So you can see we've had, all right, pretty average, and we've stayed inside of that. But the concern we've had a few weeks ago, we've been talking that every time we've gone outside these expected moves, and that was a little warning sign, because the market makers, option market, they like efficiency, and that's how they do their expected moves pricing on the options, and things like this makes them nervous. So here there was this wide move, although we didn't really touch either side, and this was what the close of last Friday, and we basically kept a close eye on this, and we came back on Thursday right to that average. On Friday we gave up. So this was a big one. And what is market thinking again? Another big volatile week. They're thinking another 150 plus market move. Not that it's going to happen, but that tells us the volatility is a concern for the markets. So the same thing happened in the QQQ. It was not, as you can see, it was much more reasonable. And because of that, we closed right on the edge of the expected move. We went above it. We touched the upper edge, came back and closed right on the lower edge. But the IWM was another, that was a wild move. Look, they had been all over. So that was telegraphing that there is going to be more volatility. And look at the size of this past week, which we closed right on the edge of lower, right on the edge of the lower band, the lower bar. And then next week is another huge expected move bars. The same thing with YM. Again, look at where we were. Look at the size of the expected move. But when you look at it, it was like really nothing, not even 1% move. But that's the volatility, which as a trader, if you know and you're on control, it's wonderful. But if you are not focusing and you're doing it casually, it can rip your head off. So just be careful. And then obviously the bonds, they had a really good day. They broke above the upper edge of the expected move. So that was the bonds outside, and the gold stayed inside this expected move. And we had a nice bounce on Friday. The silver bounced out of the lower edge of the expected move. And then financials, huge. That was big bars. And I mean, we go back, we haven't had these. So there's a concerns. It's what's happening. And energy, we've had few, but that's also, we stayed right. I mean, just a tiny bit below what last Friday's opening was. So again, it's a big expectation. So that tells us, again, these big bars are telling us, even option makers, they're having a tough time to really make sense of what's going on. Okay. So I got, I think, about 8 lessons. So I hope it is something that you can, find useful. So they're going to be very short ones. So let's start with this. This is not a lesson, but I thought let's review what has happened past almost 50 years in the long term on a monthly of the 10-year yield, where we were the highest. We were like, it's like in 1982, if I'm not mistaken. I remember those days, close to 15%. Mortgage rates, unbelievable. And I have another drawn another trend line from 95. So you see where we are. So this was the lowest we were in August of 2020. Before that, 2018 and 19, we hit the upper edge. We have a little over 3%. So this is just a food for thought that you can, if you want to do refinance and other things, this is where we are. And we are right at the edge of the downtrend from 1995. And that's the reason you see what is happening as far as the convergence or resistance. So that's what I think the past I've said. I think the markets will not mind if the 10-year note goes to 2%, because still is contained within this zone. It's when it moves up, and that will make them nervous. So just a food for thought. That's why I want to share with you with this. The next thing is, I've said it, the 2020s, although I've said it, we have a lot of innovation in the United States, but there's a lot of other countries are catching up. There's, with the story of the dollar right now being so strong, it's creating some opportunities around the world. And with this COVID and the variants and other things, once they settle down, I think we have a lot more opportunities from valuation point of view in overseas. So I thought there's about 66 countries, 66 companies. So this is a map of all the biggest from market cap point of view around the world. What is the biggest company? Just you can find it yourself, but I thought let's put it in one map. So I found it interesting, and basically the majority, I think about 26 companies, are in technology, and the next one is financial. So which makes sense. By the way, this is from as of August 16, 2021. I don't think much has changed. So just a food for thought. I thought you might find it interesting. And I want to go a little further to see all the exchanges around the world. For instance, the Asia, its total value of its markets is about $23 billion. And 3 trillion, sorry. And that represents 33.3% of the world's market cap. So it's 23 trillion. And each country, I just want to show you what is their market cap individually. We can look at it. We have the slides for this. Australia, as you can see, there's a 1.1 trillion. New Zealand is 68 billion. And then so on. We can see that they represent 1.75%. And I think this puts in perspective when you look at like Apple being $2.5 trillion, how big that is. When you see New Zealand is, 68 billion. and Apple is 4 times the market cap of New Zealand. And then Europe, so Asia represents 33%, Europe represents 19.5%. So again, putting things in perspective as far as market caps from Nordic to basically look at the DAX, the Deutsche Börse, and then we go to FTSE and London Stock Exchange. So basically, what is the value of all the companies' market caps? So about $13 trillion. And Africa, 1.1 trillion. The Middle East is 1.4, so they represent 2%, 1.5%. So anyway, I hope you find, I mean, especially if you want to look some opportunities in the Middle East, how big are they? Are they liquid? And we come to United States and you see that NYSE is $18 trillion and Canada is $1.6 trillion. And basically the whole North America is about 28 trillion. Mexico is 426 billion. So these are the, that's why North America will represent 40.6% of the market cap. And then the major ones in South America, from Bovespa to Buenos Aires, Bolsa, Chile, and Peru, and Colombia. All right, so that's just a little introduction for the biggest companies around the world and market caps. And so I thought take a couple of minutes of, we talk about the CNN, fear and greed. What is it? And it's completely different. You can see, we talked about the AAII, American Association of Individual Investors. That was a sentiment that they start interviewing everyone after midnight, Wednesday night. That goes from Thursday to Wednesday. Then they just call you, and or you can do it online. Are you for next 6 months? Are you bullish? Are you neutral? Are you bearish? And that's more a sentiment. This one is more of an internal. So basically what they use the 7 indicators. By the way, this is the history that since 2010, where we have been for the extreme. So just a food for thought. I mean 2019, sorry, in the last 3 years where we have been. The stock, so the 7 keys are the stock price momentum. They look at the 125-day moving average. The strength, they look at the breadth. So what is the, as far as advanced decline, and look at the stocks that are going up versus going down. And the put call options, do we have more put bias, or is a put call ratio, which we use part of our internal marketing. And if there's a positive thing about junk bond demand, is it higher, is it lower? The VIX is high, VIX is low. So you can see, I mean, for instance, if VIX is high, that means there's a fear, right? If junk bond demand is high, that means the complacency. The safe haven demand, again, it is basically if the money is going to the treasuries versus stocks. So they look at that. So in reality, that's what the 7 ideas. So you can see they're very much market related, not the sentiment of the individual investors. And you can see in September 17th of 2008, which we remember that day, I believe that was the Lehman Brothers news coming out. The market dropped to its lowest at 12, and it was about on March 19th was at 28. So March 9th, sorry, 2009, which was a turnaround, and that's when the major bull market started, end of the bear. All right, so that's that. I found this really interesting from the Bank of America study, and they've gone back and they looked at the inflow of equities, and we're talking about all the money coming in. Basically, you can call Fed money, you can talk stimulus money. We are at 1.1 trillion as far as the inflow. Where it has been, the inflow to equities exceed combined inflow of everything we've seen the past 19 years. And these are rolling 12 months. So every 12 months they're looking at, and this is where we are. The question is, you can see there's a little hook. So it seems like since a month and a month and a half ago, that has turned. So we want to watch that. Um, the next lesson is about silver. So I went back and looking at from 1980. Remember, we had the Hunt brothers and silver hit the close to 50. And since then, every other metal has gone way beyond that all-time high of that $1. So this is where we stand as of 2021. So compared to where we were in 1980, copper, lead, nickel, zinc, tin, iron core, platinum, palladium, rhodium, and gold, they are all way above where they were. Where are we with silver? We're still half of the amount. And we did that again. I discussed it with you as far as we hit like 49.24 something on April 24th of 2011. We had that high. So we are halfway there. So the question is, from the valuation point of view, does silver have much more room to go in a long run compared to other metals? Here we are looking at, again, where we are compared to from the price graph since 1900. This is the inflation adjusted Dow. And looking at the channels, we see we just have broken out of this channel. It happened in 1927, 8, 9. And basically, we have broken out of this channel. And then we have a short-term channel with the bull market starting in 2009. And we are very close to the upper edge of that channel too. So just again, just putting things in perspective. And since I talked about Dow, let's see, when we talk about Dow Jones Industrial Average, what it is. It's, it starts first of all by Charles Dow. He wanted to know, do we have like something more representative of the market? And he came with the idea of indexing. And he started on May 26, 1896. And basically, he started with the 12 companies, major industrial companies. And today, there's the 30 main stocks. It used to be industrial, right? So the railroads, for instance, and then we had then we ended up with the energy, and basically car companies started joining, but it was more of a original industrial. Now, when you look at it, it's tons of technology, entertainment. We got healthcare. We got again, insurance, financial companies. So basically, this is a list that you can easily have access to. And one of the other things is people ask, well, if I really want to do the Dow Jones, which is the price cap index, the more expensive the price of the component, like for instance, the most expensive one in Dow is the United Healthcare, as far as the price goes. Then it's Goldman Sachs. So they have much more influence on the index than something like Cisco, or when we think about Intel, which is under $50. So they pull the market. So you want to pay attention to that. Before Apple, the pre-split of Apple used to be the largest, and it was the largest cap in S&P, on NASDAQ, and the largest price in the Dow. So it had a big influence on all the indexes. So, but then after split, it's like number 16 or 15 right now. So we want to pay attention to that. But if you like to invest in it, then the biggest or the easiest one, if you want to do options, is the Diamond, which is the DIA ETF. So that's just a food for thought. The next lesson, I just want to review this. Again, we've talked about the skewness and what happens when the markets are, we've talked about the portfolio managers, what they think, and they're really more aggressive on buying the put side of things than the, than the call. They're willing to pay higher premium. And consequently, what happens, it increases the implied volatility of that because they want to protect their portfolio. So I want to share this with you. This is, I went, you can look at January, February. I looked at like the March monthly. This is on the SPY. Remember, SPY closed at 453. And I'm looking at the 230, 235, 240, 245. This is, you know, almost 50% cut, 40 to 50, 45% down. And there's still, somebody's willing to pay the premium to buy these things. And there's a lot of, you can see there's activities, there's open interest, and the implied volatility is like 60 to 65%. If you want to go up 50%, the implied volatility is like for the calls is like 22, 23%. So because of that, you know, there is a juicy premium here. So I don't know if you expect the markets drop 45%, then that's a different story, but that might be an idea. You can do some verticals. As a matter of fact, I just have to mention, this is a great time with all this volatility going with higher implied volatility. I would not be a buyer of directional. Let's say you say, well, let's buy the dip. Let's go buy the calls on whatever instrument you want, whatever stock you want. I would not recommend doing directional because of the implied volatility being so extended, that could drop anytime. And obviously you will lose in both ways in a sense. I mean, if the stock drops and volatility is dropping, for instance, then that call direction is not very good. So I would recommend for the next few weeks with the higher implied volatility, the way we are now, I would definitely play a debit spread. Just be, you know, choose your implied volatilities, you know, sell the higher one if you can and buy the lower one. But that would be more sensible in my opinion. Okay, unless you're doing very short term, which we'll discuss in our trade of the week. It's the last one. I want to share a scan because I know a lot of you use the linear regression channel. So I thought, what if you were looking for something as far as when there's extremes, there's a 2 standard deviation, and Thinkorswim has it. So if you haven't used it, this might be a good way of you know, scanning for some stocks that you think maybe if the market you feel they're going to go down and you have stocks that they're really overextended, this might help you. So basically, I like to have, obviously, I just want to go with more general. I don't want to put 10 different, you know, screening parameters here. So just want to go with a simple. You can add whatever you want, but I want to have at least 1 million, you know, volume. So I start with the liquidity first. So this is the one you want to, you go to the study and go to the something called standard deviation channel. Now, a standard deviation channel, in order to do that, just pull this menu. It goes to statistical, and the statistical, you go to standard deviation channel. That's how you find this. And then I want to close, and I want it greater than 2 standard deviation of the linear regression line. So I put 252. So this is a very long one for the 252 trading days, or you choose what you want. The standard one's like 63 days, so that means 3 months. You can do like with the TTM, which you use generally, it's like 30 days, 35 days. I use 100. You choose. This is like really long term. This is for whole year. And so I chose that. So we said, well, if you have this regression line, linear regression line, if you go to standard deviation above that in past 252 bars. And then I want to make sure there's another tool. You can use CCI, for instance. You could even use stochastic if you want. I use RSI. They're usually good for, at least for the overbought, oversold, not more like, not as effective as the stochastics as far as showing that the tendency of staying something. But for turnarounds, when there's something overbought and comes down, they are pretty good. So I like the RSI, and I use the regular 14 ISI. And what I want to do, I want to be greater than 70. That means they're overbought. So imagine we are outside the channel and we are overbought. So there's a good chance, again, like Bollinger Band that we look at, this is the channel. So food for thought, I just scanned it. This is, I wanted to look at it from the descending order from the price. So you don't want to, you can't play options on a 27-cent stock, or, but you can look at it, and if you have some short candidates maybe, and you can do the opposite. The opposite will be if you're looking for really oversold. So if it's oversold, then you want to make sure it's the -2. So you want to have less. So this will be less than -2. Again, you can choose whatever periods you want. And then this one, RSI, will be, again, less than 30. So we will look at oversold. So anyway, I hope this was helpful, just a food for thought. So for the next few minutes, I'll spend on the trade of the week, the few trades that I had. Couple of, again, ideas as far as when you're doing the day trading. For instance, just give you a heads up, if you have watched my internal markets, for instance, you're familiar with the trend, which is like a McClellan oscillator. Usually they use it as absolutes. I look at the trend of the trend, in this case, trend of the trend. We've talked about every time we have a close above 150, and the higher the better. I'm not looking at more into the in intraday. I'm looking at the close. 80% of the time, they usually a telltale sign that the markets will reverse. That this means they're oversold. So we were close to that 250, for instance, or 240 when we closed. This was on Tuesday close, and this was on Wednesday's close. So what that told us, that after this close, there's a good chance the market, at least initially during the day, they will go up. So you will be more on a long side of things. If you want to play futures, you will watch for that. Make sure you put your stops. But usually that means if you want to play options, maybe you could have bought a 1 day, debit call spread, for instance. So that was Tuesday. This was Wednesday. So let's review that. So this one usually doesn't, it is intraday. We like it more on the closing. So I like to have the closing of the day for the market digest things. The rubber band is really being pulled. So as I mentioned, this was Wednesday's close. This was Tuesday's close. And what happened was, this is Friday, this is Thursday, and this is Wednesday, and this is Tuesday. So this was Tuesday. You can see we opened and we went up. And after that, this nice double top, and we had this goes back to the I think it's like a low of the first hour, or the high of the first hour of Monday. So this was one. And then on Wednesday, we also, again, we had a positive, nice move. So again, there's a lot, this was a very volatile market. So, but I just want to tell, the tendency is, remember, this is gap up. So we actually started from here, and even if you have gotten in this market this way. Now, again, this was a pretty volatile market. So that's what as I mentioned, Mondays, I don't like to trade. And then the Tuesdays usually turn around Tuesday. So that's a conflict right there. So the trend, was up here. It tells you it goes up. But then for me, Monday being up, the turnaround Tuesday was a time. And I actually played that. And then I did it. You can see the trade we could have done at this time, head and shoulder, and short the market if you wanted. But that's one thing, that the trend, just in case, at least in the short term, might give you a heads up. with, again, the other confirmation. You just want to go purely on trend. It just tells you, if you want to play the market the next day, you might have an up move. That the gaps, you can see Friday, we had a gap up immediately. I mean, within the next bar, we closed that gap. Thursday, no gap. Wednesday, we had a gap up. Nothing happened till this area. We closed the whole gap and more. And then on Tuesday, we closed almost 3/4 of that gap. So even with that, I'm going to go back and just bear with me. This is that Tuesday. This is the Monday. So what happened Monday? Monday also we had a gap up, and you can see this is from Friday to this. We couldn't came close to not even half. But what happened Tuesday? We closed the whole Monday's gap. So on Tuesday we closed that gap, and the interesting thing is, on Monday we closed almost more than half of the gap from Friday, which was a big gap. That was a sell. So what happened as soon as we did the half a gap, you see the consolidation, and that's what, again, the markets, they have these memories. So when they get that half a gap, they have the aha. When they get the full gap, it's done. There's a closure, whatever reason it is. I don't know. It doesn't happen in stocks, but it happens at the futures, especially the S&P indexes. So I just sharing again our gaps with you. The next thing I want to share with you, just tell you that it's a lot of labor. This was a trade I did on I decided to do this trade. I did it on Dow Jones because I knew that a lot of volatility, and I was scalping. So this is on 30 minutes. So yeah, about 30 minutes I was in. There were 8 contracts. I was in and out. It was laborious. So I did, the reason I chose the YM because every point is $5. So getting in and out, playing multiple contracts is easier than S&P, which is, one tick is $12.50, 1 point is 50. So with the ask and bid, the spreads, it was easier to play YM. With all that, I stopped out, I think, 3 times, and I hit my target 5. And this was in half an hour. And I got out right around here. I missed that move, but then I also missed that move. So I was long, by the way. I was playing long. This was on Thursday, and the market came back. But these are big moves. I mean, this is not for faint of heart. And all this labor that I did for 30 minutes, I think I know exactly. I made $450 for 8 contracts. So, I mean, it sounds okay. Well, 30 minutes, 450, that's not bad at all. But it had to work for it. So anyway, that's one of my trades. The other trade, we did a gold trade, and I want to go in just a couple of minutes, just tell you what my thoughts. This is the trade. So I did the Tuesday. I put my targets in, obviously, on Thursday. At this time, it was around 10:30 or so. And then the next day, as you know, there was a nice move on gold and kept going, and it hit my targets nicely. So I bought them or at least at 1027, I got filled. So these are my filled price. So I bought them at 104. My first one hit at 139, even though I put 130 for the 25%, 164, 197. And then I did this was my 100%. Then the gold actually dropped, and then I manually did a runner, one of them, and it got hit. And the last one, basically, I think I just closed it myself. So it was a nice day, and I just want to go why I chose like this time to get in, and why I chose 164.5, for instance. So basically, This is a 10-minute candlesticks. So this is, I didn't get in here, right around, you see this doji, I got in here right around here. And so I didn't get in here. This is on 10-minute. So my big reason was we had retraced. This is what I was talking about, that the 127.2, 174.29. If you recall, for 7-8 days, we were just challenging. And the more you stay and the more candles there's, that's more rejection. So that's why I think I had mentioned that time, if you're selling, you have sold calls on your gold, this was really good because you could have collected all the premium. So what we did, we dropped. Now the question was, you can see the cloud was really thin, so it easily went through that. But this is the area I was looking at, that one at 38.2%, which was about 164.60. So I felt, and I didn't buy a lot because, you know, the momentum is down a lot. I just wanted to get in, get my feet wet around that 164.50 area. That's where I, once we hit it, that's where I put my buy signal. I hope it's helpful to just think what I was thinking and why it went in. The next one, the last thing is, I think exactly a month ago on November 3rd or somewhere around that, yeah, that we had a class on the VIX volatility spread. And I shared with you the spread, and at that time VIX was at 15. And I thought, you know, when the VIX is really low and it wasn't the support, this is a good time maybe for hedging. Maybe you want to do some type of a VIX strategy. You could have done debit call spread, for instance. You could have just bought a call, and these are the prices. You know, you could have bought a 20 call, which is way out of money at that time. You could have gone in the money, but the premiums were up there. And if you want to do debit, you know, it would have paid 65 cents, and you could have done that. So the idea with that spread, that the volatility spread, was, why don't we go somewhere and do actually sell a put? And we knew our downside was very low because it's the 15, 14, you know, we hadn't gone that low. So we knew it's not going to go to zero. So we have to pay the whole thing. So we sold a put and we collected something, you know, between 55 and 60 cents. And we did a debit call spread. So combining these two, basically, I financed this debit spread with this, the money that I received from this. Usually could be zero. So bottom line was, I paid 10 cents for this and I used one. Imagine if you did 100 contracts would have been $1,000, let's say. If you did 10, that would be $100. So let's fast forward to yesterday and yesterday's close and where we stand. So if you would have, let's say, got out of our position, that means we bought our 16 put, would be about 10 cents or 5 cents. And we sold our debit spread, the net, you would have been up 205 or 265, 205. So that's basically, you go from 10 to this. So it's about 20 times or so. So that wouldn't be a bad trade, right? So 1,000 will be 20,000, 100 will be 2,000. But you know, it's the timing of things, right? So, and it's the idea. You can put this in your itinerary. Once we've had again another very low VIX, maybe you could use this. I just want to give you a little update on that. And that was a December 22nd expiration. So ETF of the week, I thought this is interesting. We talk about all the, you know, the Bitcoin and the cryptos. So NFTs are very much in fashion. We started a year and a half ago with all, a lot of athletes are getting involved, a lot of artists are getting involved. It's a blockchain in the sense that it is it's a digital form of collection in a sense. You can have a painting, you can have a state of art, something, you can have, used to have collectibles, you know, cards, playing cards. So now we finally have an NFT ETF, which focuses on that. So basically, I thought to share with you this NFTZ, if you're interested. It's been open for 2 or 3 days. So this is on a, I'll show you in the 30 minutes using the linear regression channel on MACD and with our Heikin-Ashi bar. So see what they have done. So just a quick lesson. The next, I just wanted to share with you, we talked about bull flags. We talked about the classic chart patterns in our Wednesday's class. I thought let's review something. Micron, I think a couple of weeks ago, I talked about the stock of the week. It's been one of my favorite, I've owned options on it and other things, but I was very hesitant at that time to put new position, and I'll tell you why. We talked about linear regression channel. We thought we need to have a little retracement before we go in, because on a weekly was outside this 2 standard deviation. But also it came in one of my screenings, Micron came as a bull flag, and you can see, this is your pole. You see how we can put a pole right here, and this is your flag, and it meets our objectives about $5 or so, and the move was maybe $20. So it's about 20-25%. We have to watch this. So I don't have confirmation. The confirmation will be once we break above the $86 with a high volume, but still a candidate. I just put it on your watch list. So what I want to look at it as well is on the candlestick, I did the Fibonacci, and what you can see is right here, we are in an ambush zone. So again, it kind of goes with the bull flag, right? So once we break above this at 61.8, then there's a good chance we'll continue going up with a high volume, of course. And so we are in a kind of a neutral zone right now. So you want to watch it, because there's a good chance it could go down to 38.2 or more. The third part of it was when I did on the weekly, it was outside this Bollinger Band, linear regression channel, the 2 standard deviation. And the same on my 100-day channel, we had gone outside. The interesting was on a 30-day channel, we've been sticking to the actual linear regression. We went to the 1 standard deviation. I think that's where I had the suggestion, that probably would have been last week. But now we have gone back to the 1 standard deviation. So right around here, let's see if there is a pause and we can move around. As you can see, this is an uptrend. And you got to remember, these linear regression channels are dynamic. So the angle could change. So that's as far as the stock of the week. Quickly, just interest of time, this is the squeezed candidates. I used the Russell 1000, and I chose the largest volume, market caps. And you can see Tesla, JPM, United Healthcare. There's a lot of big ones in the squeeze. And I want to add second screening for you, since I talked about bull flag on Wednesday. Why don't we look at some of the largest market cap in Russell 1000 who have developed the bull flag? So hopefully you learned about bull flag, and let's look at these candidates from Home Depot, Qualcomm, Ford. So just some ideas for your weekend if you like to look at the charts and create your own, candidates. So quickly, there's some more earnings coming up this week. Costco, for instance, is important. Oracle, Restoration Hardware, again, some type of basically as far as retail, and then GameStop, which was a year ago this time. Who would have thought we are talking about GameStop? Just think about that, how life can change in 12 months. These are some of our volatilities. And the last but not least, I just want to show you some of the projections, expectations, GameStop, Lululemon, Chewy, Costco, AutoZone, and Restoration Hardware. All right. I'm sorry it took a little longer than usual. There was a lot to cover. I hope it was helpful. Again, it was a very interesting week last week, and I think it is something that hopefully it will be a good learning lesson for the upcoming times, because these volatilities are going to be with us. And what we are talking about right now is not just a short term. It's not something that, oh, we're going to use trading for 1 year and that's it. We're done. We retire. This is something I'm hoping you will build on it. So it will be a hopefully either second career or maybe main career. But we need markets like last week to learn from them, because otherwise, once everything is going well, then there's not many opportunity to make money because everybody's making it. Eventually you run out of buyers. So basically that's why it's important to understand markets like this. With that in mind, I really appreciate it. We can stop the recording and answer any questions that you have.